like Keshav said, smart money is moving heavily into oil and gas. I cannot predict the economic cycle or where the oil and gas numbers are headed, but I do like to pay attention to smart money. And when they're moving into asset classes in a certain way and there's billions of dollars being poured into oil and gas, that's a pretty good indicator that we're going to see some turbulence for now while we're going through all of this economic uncertainty with the tariffs and everything else. So we're going to see fluctuations in the stock market, fluctuations in oil and gas prices. But ultimately, once we kind of weather this little bit of wildness, I think we're going to see some really good upside, especially in natural gas prices. So.
Hey everyone, Keshav Kalor from Clive Capital. I'm joined by my partner at Clive, John Lai,
Hi, everyone.
and our partners over at Allow Energy. I hope I'm pronouncing that correctly, but Courtney Moeller and Alex.
Hi, everybody. Super pumped to be here. It's Aleo, which is
Aleo. Okay,
Greek. It's oil in Greek.
I'll get that right. Aleo. Okay. Okay, so today you are joining us for our latest and one of our most exciting investment opportunities. I don't want to say most exciting because I don't want to tick off our other partners, but we love it a lot. Our investors love it so much so that every time an investor gets on a call with me, they don't even ask me how my day's going or how I'm doing. They just ask me what our next oil and gas investment opportunity is. So you'll see why that is and why there's so much fervor and interest around it. But without further ado, we will get into DW Select 5, DW Select Bakken 5, our latest investment opportunity with Aleo. Yeah? Okay, Aleo, there we go. Standard general disclaimer stuff. Well, before we get into that, this presentation is going to be about 30 to 35 minutes. If you have any questions along the way, just throw it in the chat. We'll get to it as we can, and we'll leave some time at the end for Q&A as well. This webinar is being recorded, and we will send it out later. So general disclaimer, I'm not going to read through all of this. Please review it on your own time, but we're not financial, legal, tax advisors, anything like that. Please consult your own professionals. All investments do carry risk, and including the risk of loss of capital, and also past performance does not guarantee future results. Any numbers here are just projections. So with that, we're going to get into why is now the time to invest into oil and gas. So to start, it's a pretty simple supply and demand equation. We're currently 5 million barrels per day deficit. We're in a deficit of 5 million barrels per day, and that's projected to grow to 7 million barrels per day by 2030 due to various factors, but a couple of them are one, China coming online out of their COVID lockdowns, and two, as more and more countries industrialize and modernize, their energy requirements are going to increase as well. So this demand is going to continue increasing, and smart money recognizes this too. That's why they're going all in on oil and gas. There's a little investor that some of you may have heard of called Warren Buffett, and Berkshire Hathaway, his company, manages about 250 or 270 billion dollars right now. $30 billion of that, I believe, roughly 10%, is in oil and gas stocks, in Chevron and in Occidental Petroleum. Now, we're not all Berkshire Hathaway or Warren Buffett, but why does it make sense for everyday investors like us to get into it? Well, for starters, diversification is huge. Most of you are in the stock market, and that's all right. And some of you may be in real estate or other small businesses or crypto. But what most of these other asset classes have in common is that your payday depends heavily on the appreciation of your asset. It takes time, and you have to wait a couple of years to see any of your gains. Real estate and other businesses are great. You have some cash flow, but your big payday really is on the exit. So that's far out. Whereas oil and gas, on the other hand, your paydays are on the front end. Most of your returns are going to come in the first 2 to 3 years, and then it starts decreasing. Whereas real estate and other investments, you have to wait over time for it to increase. And in general, oil and gas is not correlated or as heavily correlated with the stock market or real estate. So it's just another good way to diversify into non-correlated asset classes. And Courtney, John, Alex, feel free to jump in anytime also.
Yeah, I was just going to throw one thing in. I mean, obviously, all asset classes are cyclical, but the great thing is that oil is usually inverse to real estate, which is great. And one of the things that I did want to kind of back up on is talk a little bit about this new administration. Trump has stepped in. He keeps talking about drill, baby, drill, and typically we have lower oil prices during, a Republican presidency. So what does that mean for oil and why is now a good time to invest? And I have spent a ton of time over this last couple of months talking to multiple operators and finding out, what their plans for this year is. Are they modifying and changing anything based on this new administration? And even though Trump is saying, "Hey, we're going to ramp up production," I have not come across any operators that are planning on doing that. First of all, they're not going to just step in and just tank oil prices. Nobody wants that. Their money that they're making is also based off oil, the price of oil, just like ours is. But the other problem is there's a capital constraint here too. These horizontal wells are 10 to 20 million dollars a well to drill. And, some of these major top operators can absorb some of that cost, but we have 48,000 oil and gas operators in the United States, and the majority of them can't just go ramp up their drilling because there's a capital problem there. So, really, what they're very excited about is the fact that regulations are going to be easing and it's going to be much easier to get the permits processed and get through the regulations are going to ease. So nobody's really ramping up production. And actually, a lot of them have said what we need to do is build, baby, build, because a lot of the infrastructure that we have for our pipelines and transportation and things like that are very, very old and they need a lot of rehab and some of those things. So I think the focus is going to be a little bit different. And like Keshav said, smart money is moving heavily into oil and gas. I cannot predict the economic cycle or where the oil and gas numbers are headed, but I do like to pay attention to smart money. And when they're moving into asset classes in a certain way and there's billions of dollars being poured into oil and gas, that's a pretty good indicator that we're going to see some turbulence for now while we're going through all of this economic uncertainty with the tariffs and everything else. So we're going to see fluctuations in the stock market, fluctuations in oil and gas prices. But ultimately, once we kind of weather this little bit of wildness, I think we're going to see some really good upside, especially in natural gas prices. So, oh,
I'm on
Kesha.
mute. Yeah. That brings me to my next point. It's a great segue that natural gas is up to $4 now. And a lot of that, Courtney, you and I talked about this, is driven by the AI boom. That's, somewhat here, but I think it's continuing to come. Every little ChatGPT inquiry that you put in there is just going to consume more and more natural gas. So that's another reason that we are especially bullish on oil and gas. Obviously, though, that's just the future of it and the diversification. There's obviously the unparalleled tax advantages, better than real estate, or honestly, a lot of other opportunities that we found out there. We're going to dive into that a little bit more, but at a high level, you have the potential to offset any type of income. Last, we checked with our CPAs, including W-2, active income, passive income, and capital gains. And there's no limit to how much you can offset in any of these areas. In real estate, the typical problem is the tax benefits that you do get. You or your spouse has to be a real estate professional to take those losses against active income. Here, there's no such professions requirement. Anyone can take it. But again, we're not a CPA, so we will be including a sample K1, a redacted K1, and you can check with your own CPA to make sure it applies to your situation. But I think the fact that it applies to any sort of income and there's no cap on it makes it a really powerful combination. We'll dive into that a little bit later on a later slide. And also, in addition to the depreciation benefits we're getting, the tax losses, there's also the depletion allowance, which is an additional tax benefit, which we will also cover later. One second. Okay, but before we get into that, this is a great opportunity. But even more important than that is who are you investing with? So you're investing with myself and John at Clive Capital. You're investing with Courtney and Alexis at Aleo Energy, and you're investing with DW Energy. So for each of our experiences, Clive Capital, we founded over 3 years ago. And, my background in Amazon and currently at Meta, John's more stellar background currently at Amazon, but before at Apple and Yahoo and Bear Stearns and Mitchell Madison Group. We help tech professionals primarily, from these big tech companies like Amazon, Meta, Google, etc., other professions as well, invest passively into these private equity investment opportunities for financial freedom, generational wealth, tax benefits, passive income, all that good stuff. And so far, we've helped our investors invest into over 1,000 apartments under renovation, 500 single-family rental homes under development, industrial real estate, private loans. So far, 8 oil and gas wells, but hopefully soon after this opportunity, that will be 16 oil and gas wells and more to come. So that is our profile, and we generally target a 15 to 30% IRR conservatively on our opportunities. So with that, Courtney, if you could let us know a little bit about your background, and Alea.
Absolutely. So I am originally from Midland, Texas, which is right in the heart of the Permian Basin, which is the number one producing oil and gas area in the United States. It's responsible for producing like 60% of the oil that the United States produces each year. And I like stats, so just to give you a little bit of an idea, we use 21 million barrels of oil per day, and we are the largest producers at 13 million barrels a day. And so, like I said, the majority of that's coming out of the Permian Basin. My father was a petroleum engineer, my brother drilled oil, my uncle has a well servicing company, and we have lived in the United Arab Emirates, in Pakistan, and my dad drilled for 20 years in Jakarta before he retired. So I inherited his oil and gas company about 13 years ago and have continued to drill throughout the United States. And gosh, about 4 years ago, when I was trying to diversify my portfolio, I learned about syndication and thought, man, the tax advantages and everything, this is such a great opportunity. I want to help my family and I want to help my friends. And now it's grown to, I want to change the world and, keep $1 billion out of the hands of the IRS. And so I met up with DW a couple of years ago. I found them because I was looking for a great oil and gas partner. And there's a lot of companies out there. There's a lot of characters in this space, but I really liked their strategy and I approached them and asked them if they would be willing to work with me. And they said, yeah, let's give it a shot. And Rick Bonneau, who is now the principal or the president of DW Energy, he's a landman. I absolutely adore him. He has every bit of honesty and integrity that I want in a partner. And they have done more than 170 partnerships like this. They opened their doors back up in 2008. They have partnered in over 700 wells. They're producing a ton of oil, and this will be my fifth project with them now. So I'm very excited about that. Since then, we've done 28 wells, not including this project, which I guess I could add them on. They're paid for, they're ours. So I guess that takes us up to what is that? 36 wells is what we'll be at now. And we paid out $2.4 million over this time frame and kept $17 million out of the hands of the IRS. So I'm very proud of that. I'm very proud of the strategy that we have implemented, and that strategy just continues to keep getting better and better as we move along. So I'm really excited about this deal, and the track record's good. And one other thing I do want to point out, Rick has been involved in 1,100 wells. So the 700 plus from DW and even 400 additional on top of that. In those 1,100 wells, he has only ever had 6 dry wells out of 1,100. And I think that's a really important fact, because a lot of people are always like, what are our chances of a dry hole? And they're pretty darn slim, especially with today's technology. So I wanted to add that in there.
Yeah, I know the 700 wells figure here, so I was wondering where the 400 discoveries came from, but I'll throw that in the slides as well. That's a good call out.
Well, it's because the 700 is DW's, but Rick has done other projects outside of DW as well. So his personal total is, more than 1,100.
Yeah, one day we'll get there too.
One day, yes,
Yeah.
one day.
Okay,
Um,
that sounds good. Yeah, go ahead,
and I
John.
was just going to make one note about the note about diversification. I mean, most of our audience knows about residential real estate, might be invested in commercial real estate, and then that has a specific profile. I mean, set aside the cyclicality of it, but that has a specific investment profile. You have to be in the investment for call it 5 to 6 to 7 years, and that's where we thought that there would be both interest and that oil and gas fits as another investment class that has a different investment profile. You're in there not for that length of period, but the bulk of the cash flow comes early on in the investment, right? Add on top of that the tax deduction, it makes it really interesting a class of investments.
No, and that's such a great point because it really is about the momentum and velocity of money. And with oil and gas, you can make that investment, get those tax benefits, get your capital back relatively quickly so that you can redeploy it into additional assets. And then really you have funded two different assets in a relatively short time frame.
Yeah. Well, we're gonna definitely walk through that a bit more just so people can understand how that works. As far as the business strategy goes and what it means to be investing into this, Courtney, again, jump in. But what we're doing here is, similar to how we have realtors in real estate. Courtney mentioned we have landmen in oil and gas, and landmen track the transactions of mineral land, out in West Texas, in North Dakota, where these wells are, in Wyoming, etc. So when they notice a major player, for example, an Exxon coming in and buying land, that means Exxon knows that there's oil and gas to be found in the area. Typically, they pay geologists ahead of time to get these studies done to find these deposits of oil and gas so that they're not just out there drilling every square inch of our beautiful country. And once they have the studies, they start going and buying in the land. That means, we know that they know they've done their homework. So landmen, Rick, for example, and DW, they come back and let us know. We start going and buying land in the vicinity too, and we get in right next to them. So we buy land that Exxon would have otherwise wanted to buy. They don't necessarily want us there. They don't need us there, but we just want the investment opportunity and the tax benefits and the returns. So we buy land there. In addition to that, or the land lease, right? We buy a lease to the land, Courtney.
Right. Yeah. Most of the time, the land does not come with the mineral rights. And so most of the time, we are either acquiring the leasehold, which is, a certain acreage area, and we'll get all of whatever the percentage of rights that comes with that leasehold, or we're actually acquiring wellbore interest, which is not any mineral rights in the land. It is a specific interest amount in those wells. And we actually have a combination of those two things in this deal specifically. And I just want to elaborate a little bit on that. When these major companies are acquiring these mineral rights, which a lot of them are federal, they're acquiring them from the federal government, super, super cheap. Once they've gotten to the point to where they've either started drilling, they're about to drill. We've got a really great group of kind of mineral brokers that bring us opportunities that say, hey, Courtney, Exxon or EOG or Anschutz, they're going to drill some wells over here. We have a 5% interest in those, either in that leasehold or those wells. Are you interested in it? And so we take a look. And so these major operators are not raising private capital. They're not raising public money. They don't need our money or our participation. They are the skin in the game. This project here is $90 million to drill, and we have a 3.5% interest up to like a 6.5% interest. So we have a very small interest in that overall project that's $90 million. The way we get to participate, because they don't need us, is that somebody else owned those small interests and they were willing to sell them to us. So we really like what they're doing. I know that when these major operators are going in and drilling, they've got the top of the line geologists and landmen and technology and equipment. And I'm very confident in their abilities to drill these wells and make things happen. And we are just kind of riding their coattails. We are reaping the benefits of what we know these great companies are doing. And if you're going to drill, this is who you want to drill with. But most people don't get to participate this way. So being able to go in with Slawson, who's drilled thousands and thousands of wells. It's exciting. So I just wanted to mention that because they don't need our money. They didn't want our money. They didn't ask for it. We just found a way to backdoor it into their deal, which is amazing.
Yeah, definitely. In addition to the rights, we also put up money for the equipment as well, right? And some of the other expenses towards
Yeah,
the
and
total
there
project.
was a question that just popped up, and it's actually really good. They said, why would other investors sell their interest and then we would acquire it? Well, and that's a great question. So part of that, our drilling costs for this project are about $6 million. Some people don't have $6 million laying around to cover those drilling costs, so they have to sell those interests. And some people are mineral flippers. When the federal government brought these mineral interests up for sale, there was nothing happening on this land, so it was probably $250 an acre. Well, some of this stuff we've bought for 5,000 an acre, 7,500 an acre. So the people that bought it when the government sold it at 250, they're just flipping it. And now that somebody is drilled, just like real estate, the more you have a piece of land developed, the more it's worth. The further along we are in the drilling process, the more these mineral rights are worth. So they're making a ton of money waiting for somebody to drill and then sell them to us. And then some people just don't have the capital sitting around to cover their part of the drilling costs. So they sell them because if you own them and they drill, you're on the hook for those drilling costs, and it's $5 million. And a lot of people don't have $5 million sitting around to participate and cover those expenses.
Yeah.
That's a great question.
And then I guess we have another one here. We're on the macroeconomics. How do you expect tariffs to affect oil prices?
And that's a great question. I don't expect it to affect us on our part of the drilling and production because you've got upstream, midstream, and downstream in the oil processes. So upstream is actually drilling, midstream is your transportation. So that would be your shipping or piping. And then your downstream is all of your products. So the tariffs don't really impact us much on that, on this drilling process, on the drilling part of this. So I don't expect us to see any kind of impact from that.
Okay, there's another pretty loaded question, but we will answer it incrementally. So just pay attention to whoever anonymous attendee is. Your questions will be answered. Okay, so with that, past deals, these are the past deals that Courtney has put together so far. I personally invested into Wyoming 2. I was pretty close to investing into with another operator and a Ponzi scheme. I know Courtney, you and I have discussed this at length, but she saved me from that, luckily. And from personal experience, I didn't understand much about the oil and gas industry, so I wanted to put my own money first. It's been working out great, as we're about to go into here, and that's why I've brought this opportunity now to you all once I have a better understanding. So in that first investment, Wyoming 2, November 2023, I was able to, for every $100,000 invested, reduce my Meta W-2 taxable income by 80K. Already filed those taxes, not audited. And secondly, through the monthly cash flow, now that we're, I think, 15 months in or so, I've gotten close to about almost 50% of a return in just 15
And what
months.
I do want to point out on that is because these oil companies pay, so even though we're sitting in April 1st, it has only paid out 13 months of production. So it's only paid out through, I think, either the end of December or maybe January. I'd have to go back and take a look at the reports. But that, even though they've come online and that's what it returned, like you still have several months of production that it hadn't paid on because they pay a month behind and then we have to pay a month behind because it takes a bit to process all of this. So that is not for the full time frame that it's been online. So I always like to point out that there's several months of production that have happened that you have not been paid on just yet.
Yeah.
And I've invested
So
in Select
go ahead.
before, just as a FYI. So
Yeah.
I've seen, I think, about 85% deduction on my taxes for this year, or 2024 rather.
Which
Yeah.
is, and I do want to talk about a couple of these other things because Wyoming 8, those wells came online August 1st. And so they've been online for quite some time now, and they have not started distributing yet. And it was really frustrating. This is a highly irregular thing to happen, but what ended up happening with that deal was there was a title issue, and it wasn't between us and the seller. We actually agreed on what we purchased. The title is clear, but EOG's attorneys did something weird with the documents, and when they ended up giving us our division orders, it was only for half of what we actually owned, and we were like, hey, this is not right. So they've just about gotten it fixed. It's been a kind of a slow process. Fortunately, the great thing is this is very, very highly regulated industry, and these are very reputable, good companies. So even though we had those delays, there's not any question that we are going to get paid. We started earning the moment those wells came online, and we actually got an email 2 days ago that said, "Hey, we've got this fixed. EOG's attorneys have signed off on it, and we should be getting new division orders any day now." And then as soon as that happens, we'll get the revenue, and our investors will get all 9 months of that distribution in, all in one check, all in one check. And then from there, it will be monthly. So I wanted to point that out because most of these deals start cash flowing within a like 3 to 6 month time frame. Every operator's a little bit differently. Colorado 3, those wells came online January 1st, and we just did our first distribution to investors on April 1st. They got January's full month of production, which was great. And for $100,000 investment, they got about a $4,000 distribution. And so that was the first month they were online. These newly fracked wells will kind of ramp up their production in the first 6 months of life. They have a lot of water to bleed off when they first kind of come online. All that water that was pumped in and injected to frack these wells, they've got to bleed that off. And as that bleeds off, the production numbers come up. So those numbers will kind of stabilize and increase over the next several months, and then we'll start depleting and going down. So I just wanted to point that out. They're kind of all over the place. We have what's typical, and most of these companies are very, very typical, payments, 3-ish months after they come online. But every now and then you hit a title snag or something else. And it doesn't mean there's a problem with the deal or anything else. It just delayed distributions. So that's all.
Yeah, that's a great call. As with any investment, there's going to be some, risk or something that doesn't go according to plan. And so distribution timelines vary, but once they start, it's monthly like clockwork. And, but the other things that we can guarantee, well, not guarantee, but, tax returns are always on time, monthly updates are always on time, and we'll dive more into that. Okay, next. Yes, tax benefits. Okay, so again, this is the slide that you have all been waiting for. The tax benefits in these opportunities are from two buckets. They're from intangible drilling costs, IDCs, and tangible drilling costs. Intangible drilling costs are just costs that you can't resell and are general business expenses like fuel, labor, transportation, etc. Typically account for 60 to 80% of the total project cost. And then tangible drilling costs is mostly the drilling equipment cost. The IDCs, intangible drilling costs, can be depreciated 100% in year one, and the tangible drilling costs are depreciated over a 7-year period. But worry not, I know in real estate, depreciation and recapture is a huge topic. That's not something we have to worry about here because we put all of our costs, all of our equipment into use. We also hold the deal for a pretty long time, 20, 30 years. I don't want you to freak out when I say that because we'll explain why it makes sense to do so here in a few slides. But because we hold it so long, the risk of recapture is like negligible, basically.
Well, and the recapture on the IDCs is non-existent. That money went in to drill the wells, and you can't undrill the wells. You do have potential recapture on the tangible drilling cost, but we are talking about a very, very minute, small amount. That active income you're going to get, there's no recapture on it. So I do want to just point that out.
Yeah. Okay. And again, so those two make up the roughly 80% K1 loss. Again, just a paper loss that you will see on your taxes in year one that you can take against W-2, active, passive, or even capital gains without any limit. The other great tax benefit is the depletion allowance that basically says, hey, every, call it $100 you get, the first 15 bucks goes untaxed. So that's another great tax benefit here with oil and gas. Now, the risks, right? All of this sounds really good to be true, too good to be true, but that's not the case. As with all investments, there are risks, but we are also mitigating them, which is on the next slide. So the most straightforward risk here is just the volatility of oil. Over the last 5 years, we've seen it go anywhere as low as less than $0 during COVID to as high as $120 a barrel or something when when the Ukraine-Russia war first broke out. And so uncertain commodity prices lead to uncertain returns. And it's kind of a double whammy effect because if prices go down a lot, not only does that decrease your return from that angle, but operators also reduce how much they're producing. So that also brings down your returns. Next, there is no assurance that oil and gas will be found, or that if it is found, it will be in a quality or quantity that's, sufficing for commercial production. Although we do try to minimize that with the geological studies. And next is delays in drilling and operations that we just discussed. We don't know when these companies are going to drill or distribute. We have a good estimate, but we don't control the operators. They are their own entities, their own companies. And then lastly, monthly operating costs could exceed monthly production, and that would occur if oil prices drop too low, like it did during COVID. That being said, with all these risks, we're obviously being smart as investors, and here's how we're mitigating it. So our returns are modeled at $70 a barrel of oil, and that's the average price over the last 5 years, including the period of time where oil was negative during COVID. So that's one. And as this demand deficit continues to grow, we expect the price of oil to grow too, but just being conservative, we always want to underpromise and overdeliver. So we're not accounting for that. Second is the break-even price for this project is $37. So if we want to cover all of our expenses, that's how much we need to be selling oil at. And on a per gallon basis, that's less than $1. So I don't think that's happening anytime soon. I'm sure we all wish it would as a consumer, but as an investor, it isn't. Next is conservative estimates on the estimated ultimate recovery, the EUR, how much we think these wells are going to produce. We are going to undershoot that just to be safe. Next is the diversification across 8 wells. So even if one goes dry, which is pretty slim chance, as Courtney mentioned, 6 out of 1,100, there are 7 other wells that can make up for it. We're also diversifying across 2 operators, the 2 companies we're investing with, Koda and Slawson, and in 3 different locations. We also have correct me if I'm wrong, Courtney, but a 10% contingency reserve in case expenses outweigh revenue in certain months, like we mentioned during COVID. But just for historical reference, over the last 17 years that DW has been operational, it's never done a capital call. And even if it had to, it pales in comparison to a real estate capital call. Here, every $100,000 invested, it might be a couple $1,000s at, worst that the capital call could be.
Worst case scenario, it's probably closer to $500 because we were probably still producing, which will cover some of those costs. So, I mean, you're probably talking somewhere in the $500 to $1,000 range. So it's much, much less significant. But like you said, DW's never had to pass that on before.
Yeah. And lastly, to round it out, who we work with, right? The operators have a lot more skin in the game than we do. We have 3 to 6%, little league interests. They have the lion's share of the equity in these projects. Compare that to real estate, where investors typically have anywhere as high as 30, 40%, where they're contributing capital. Here, we are, again, like Courtney said, just riding their coattails to success. And also that comes with working with obviously the right companies who are reputable, who keep their lease operating expenses, LOEs in line, and just run a very tight ship. So all that being said, what is the exact investment opportunity? It's 8 wells that we are buying in the Bakken mineral formation. I would say it's the second best mineral formation after the one out in the Permian. This one, the Bakken's out up in North Dakota, and we are buying 8 wells in Divide and McKenzie County, 4 of the wells with Koda and another 4 with Slawson, who are 2 of the largest and most successful operators in this mineral formation. They have advanced drilling technology and completion technologies. This industry is constantly changing, constantly innovating. So if you think about it, there could be an appreciation play here where there's some amazing technology down the line that allows us to drill and extract even more oil than we originally projected from these wells. And that's something that we get to benefit from as investors. And that's also why they're outperforming some of the other wells that we are about to see here shortly in another slide. So the offering, we are raising almost $8 million from investors. Some of that money has already come in, so there's less space available. Before we even got into this opportunity, as I mentioned, there's been a lot of demand. almost $6.5 million in soft commits. So, definitely move quickly if you decide this is something you're interested in. And this is going to be a 506C investment opportunity for accredited investors only. You will have to provide proof of accreditation, which we will go into later on how to do that. The hold period here, we are holding these wells for 20 plus years, as long as they continue paying us. And you might call us crazy, but the reason we do that is because we get most of our capital back, like Courtney said, in the first 2 to 3 years, conservatively. At least from cash flow, definitely between cash flow and tax benefits. So at that point, like Courtney said, you can use that money you got back very quickly, put into another investment opportunity, while this opportunity is still paying you, a good percentage return every single month. It's free money at that point, basically. So why would you sell and give that up if you don't have any capital in the deal? This is going to be a limited partnership, and investors will have the opportunity to invest as a general partner, though, in the first year so that they can get the tax benefits and take that deduction against their active income. In year 2, you'll be transitioned to a limited partner. And this closes either at the end of April or when we fully fund the opportunity, which could be sooner, just based on the demand and what we're seeing from investors. Especially now with tax season, I'm sure everyone is crying over how much they're paying to Uncle Sam. And that pain of paying more money than you have to, rather than keeping your hard-earned dollars, is going to hit home pretty hard. We are estimating a 2.6x equity multiple over the lifetime of these wells, with 80% of that, so roughly a 2x in the first 5 to 7 years. And to get to that return of capital point at $70 per barrel, that's going to require about 375,000 barrels per well that we're buying. We covered the tax loss. There is going to be a one-time upfront fee that we're charging of about 9% to cover acquisition and management. In typical, a hedge fund world or real estate, people charge a 2% acquisition fee or annual asset management fee. If we were to charge that every year for the next 20 years, that'd be 40% in fees, and that's a little ludicrous. So we're charging it upfront once.
Yeah, and I do want to just throw something out there because from my real estate people, that is significantly more than what they see. It is a one-time fee, and it is some of the lowest management fees that I've ever seen for oil and gas. Most that I know are running anywhere from 15 to 25%. So it sounds like a lot. It's a one-time charge, and we like doing it one time at the beginning because it also counts as a business expense, which also passes on to the investors as depreciation. So it's also strategic.
Yeah. We get to keep our lights on, you get to reduce your taxes, everyone wins here. One of the questions that came in regarding the tax loss, that is just for the first year. That 80% is just for year 1. Future years, you might it'll be a significantly smaller amount, and that can be used to reduce passive income. The other question was, how long will it take for the wells to be drilled?
So the first 6 wells have been drilled. These wells are done in 3 steps. You have a drilling team, a fracking team, and a completion team. And so the first 6 wells have been drilled. I know number 7 of 8 was started on March 20th, and I'm waiting for an update on that last well. I have a feeling that last one is probably already been started. I've been waiting for them to give us an idea on when they're going to come in and frack and complete. The fracking process just takes a few days, and the completion is pretty quick as well. So once we get on that schedule, it should be relatively quickly. And a lot of people will ask, why is there a difference? If they've drilled these, why are they sitting there? And it's because the drilling team has a schedule, the fracking team has a schedule, and depending on how many wells these companies are drilling, which, like I said, these are massive companies drilling a lot of wells. Some of them are drilling, 250 wells a quarter. So they might have had 15 wells on their schedule that were scheduled to be fracked before ours finished being drilled and got on there. So it's just a matter of scheduling. So just so you know.
Yeah. And so one question that came in regarding LP and GP, this is a limited partnership, but to get the tax benefits and to be able to take them against your W-2 or active income, we are offering the opportunity to select to invest as a GP. Doesn't mean you have to actually, materially participate, but you can invest as a GP in year one, get the tax benefits, then transition over to being an LP or a limited partner in year two. If you want, from the get-go, you can choose to be an LP, but just know that you cannot take those deductions against your W-2 or your active income. And we have another question in here about previous investors who are on H-1B visas. That's something we are looking into, and we'll get back to you with that. The other one, the opinion on a possibility of the current administration to force oil costs to go down and the possibility of Saudi Arabia to start more production regarding aggressive negotiations with Russia. This is a lot of geopolitical
Yeah.
games.
No, and these are really great questions. And here's the thing, we're gonna see some volatility and some fluctuations. Our projections, we're not looking at what are we gonna do for the next 6 months, or this is a long-term investment. And the great thing is if the oil prices go down, these oil companies are gonna slow down their production because they don't want to mass produce their oil at $40 oil. They want to reserve it and wait for prices to go back up. So there's definitely some manipulation and some things going on. If OPEC decides to flood the markets and ramp production up, there's things that our operators will do. They've gotten very efficient and very good at what they're doing. So, like I said, we'll weather that storm, and it's going to happen, guys. We're going to probably see in this deal prices over $100, and we're gonna see higher and lower prices. It's going to happen. I wish I could predict when each of those things is going to happen. I can't. I think that we are really primed for really high prices because, like Keshav said earlier, China hasn't finished fully coming back online, and that's why we are operating at a deficit, but we haven't felt it in price yet. And once China continues to ramp up and they're back online fully, we are going to feel that, and people that are invested in oil and gas are going to be very happy with that investment.
Yeah. This is not as predictable as a real estate investment. Real estate rents generally just tend to go up, but oil and gas, the prices do this. So, just make sure you're strapped in for the ride, but we wouldn't be investing in it if we didn't think it was a good long-term investment. And lastly, on this slide, after that upfront fee, we split profits 86-14 in favor of our limited partners, or our passive investors, I should say. The GP, that's just, Clive and Ileo and DW, that's the 14% there, and some of our other partners. Just because I know before we said you invest as a GP, so there might be some confusion there. So here is the offset production maps. Courtney, I'll probably need your help on this slide the most, but I'll do my best. These maps basically show you where these companies are drilling, the wells we're investing in, and then what other wells are producing in the area. So on the left, you see Slawson's 4 wells called the Daredevil wells. We've acquired a 3.5% interest or equity stake in them. This is in McKenzie County in North Dakota, and these wells are estimated to produce over their lifetime of 20 years, 1 million barrels of oil over the next 20 years, not per year, but the entire time. These wells are all online already. No, 2 of them are online
No,
in
none of
February.
them are online yet. So,
Oh,
and I can help you out with this. So the 2 of the wells were spud 214 and 217, and then I just found out that the third one, so the first 2 are drilled. They're probably ducks now as well. They haven't changed the status on the site. It takes like 30 days for them to implement those changes. That third well I know was spud on 320, and spud means that the drill bit has actually broken ground and drilling has commenced. So I know the third one, and I'm pretty sure the fourth one has been started too. I just haven't gotten that confirmation just yet. Ducks means drilled incomplete. So all 4 of our Coda wells have all been drilled. We're just waiting for them to come in and frack them and complete them and bring them online.
thank you, thank you. I'm getting the lingo, but we're getting there. But we mentioned our equity interests here again to show you that we are just a small fish in the big pond. Most of it is other operators or other groups like ours who hold the rights, but also mainly Slawson, the operator. But you'll see here that other companies, when they began drilling, what they have produced so far, this is all public data. And you'll even see some big names on here, like Exxon drilling just, I don't know what the map scale here is, but a couple
Yeah,
hundred
it's
miles.
about an inch is about 3 miles. So
Oh,
these
three.
are relatively close wells.
Yeah. So based on this offset production data, that's how we are able to build out our estimates of what we think our wells will produce as well. But again, as with all things, they are just estimates and productions. And, like Courtney mentioned, it's pretty similar here on Coda, but it's just 750,000 barrels of oil per well, so a little lower. And these are our interests, and those are all drilled. But again, like Courtney mentioned, waiting completion. Open question. Okay. That one's going to take a little bit more time to answer. The timeline here. So again, the Coda Amber wells have already been spud. Drill bits have broken the ground. The Coda Bach wells have been spud as well. So all the Coda wells, drill bits have
Yeah,
broken
they're
ground.
drilled. Those are all drilled at this point. They are finished drilling. We're just waiting on the next step.
Yeah, completion, fracking, I guess. And then two of the Slawson wells have been spud as well. Again, drill bits have broken ground, and we are waiting on two more. Wells should be completed and brought online, sometime late spring, early summer, by June or July. That's when we'll start receiving production numbers as well. And then we'll start receiving distributions late summer, early fall this year.
Yeah, and
Again,
I put some like 3 month windows on here because since we have multiple wells with different operators, those amber wells are going to come online at a different time that the Bach wells that come online and start paying out from the Daredevil wells. So there's going to be a little bit of a variance in there. They won't all come online and start paying at the same time. So I just wanted to point that out.
yeah, we do have in all caps here. Again, we do not have any control over the operators or the distributions, but once it does start, it's going to be monthly. But we generally estimate that 3 to 6 month timeline, hence why we're saying end of summer, early fall. Okay, that brings us to white glove service, what you can expect right now and also once you invest. So service matters. We're going to be providing monthly drilling reports and production reports. Our investors rave about the level of detail in our reports, and once you join us on this opportunity, you'll see them too. This includes distribution and production for each of the wells, as well as line item expenses, check details, and a whole lot more. Also, we'll be sending out monthly cash distributions again once they start in that 3 to 6 months time frame approximately, but it is clockwork. My rent gets deducted the first of every month, and the only way I feel better is because my oil and gas investments also pay me on the first of every month. Annual on-time tax deductions mid-March, so that at least this investment won't be the reason your taxes are delayed, but some of the other investments we have might be, so apologize for that, but that's just what you get when you invest into private equity. And lastly, regular communication on production, progress, and things like that. We're not going to leave you just left in the dark. You can call John or myself by cell phone or by email. We're happy to answer any questions that you have. And for your reference, since 2008, since DW's, started in the business, they've delivered monthly reports, distributions, and tax returns all on time without ever missing a beat. Some FAQs here. So our investors have sent us some FAQs just because they're ready to get moving. And here's some of the most popular ones. The first one is, does it matter whether or not we invest from a self-directed IRA account or some other type of account? The one thing we'll mention here is this is definitely, you should something consult with your CPA about. Generally, if you want the tax benefits, though, you want to invest from an account that doesn't already have tax benefits, like retirement accounts. You cannot take a retirement account that already has tax benefits that wouldn't really pay taxes and then apply tax benefits because what tax are you offsetting? So that is something that we'll call out. And if you have any doubts, just feel free to ask us. Second, why can't you just invest in an oil and gas ETF or a publicly traded company? As with private equity in general, if you want the tax benefits, if you want the superior risk-adjusted returns, especially the tax benefits, you want to be a direct owner, a direct equity owner in the company rather than just owning a share, like rather than just being a shareholder of a publicly traded company. And in addition, these are smaller companies, they'll move faster. You have more transparency. There isn't the bloat or the excessive expenses of larger companies like Exxon, for example. Third, how does the transition to renewable energy sources affect oil and gas investments? Oil and gas is not going anywhere for the next at least 10 or 20 years for, I would say primarily three
Not in our
reasons.
lifetime. Not in
Yeah,
our
not in our lifetime.
And I
and
will
come
also
back.
tell you, renewable energy has been around for decades. This is not something new that just popped up, and it has grown less than 1% each year in that time frame. And it's still, our energy is provided from oil and gas. I think it's 84%, and the amount that renewables contribute to that is very insignificant. And I'd also like to point out that windmills take about 500,000 barrels of oil to run and operate during their lifetime. So there is a significant amount of oil and gas that's actually even needed to create these, renewable energy resources. And a lot of these European countries that had gotten rid of natural gas and had gone to renewable sources are now backtracking and getting rid of their renewables, and they're going back to oil and gas. And we're going to happily send them all of our natural gas from over here because we have a massive amount of supply that we can do that with. So,
Some of these things just amuse me. Like, yeah, what Europe's energy policies, but well, we won't get political. Anyway, so oil is used. I mean, the first thing that people think of is transportation. Passenger vehicles, sure. Maybe electric vehicles take over the market, but you still have large cruise ships, shipping container ships. You have airplanes, you have, tractors and other big construction equipment, drilling equipment. All of these things need oil to run that you need to replace. Secondly, with natural gas, again, a lot of that energy demand from AI and just modernizing, industrializing, that energy demand is going to continue increasing at a pace where renewables alone cannot keep up. And then third, oil and gas isn't just used for energy. A lot of the byproducts of oil are in over 6,000 products that we use daily, from shoelaces to makeup to medical equipment to windmills, like Courtney mentioned. So you would have to replace the supply chain and the production lines of all these different materials, and that is not going to happen overnight. And again, these changes take decades, maybe centuries. Our investments, most of your returns you will get in the first 5 years. So, your time window for most of your returns is not, it's not stretched out. Fourth, the importance of doing due diligence before investing in these opportunities. As I mentioned, I almost invested in what will likely become, outed as a Ponzi scheme here shortly. The oil and gas space is less well understood than real estate, so you should definitely be aware of scammers and fraudsters. And that's where working with honest, transparent people comes into play. And then lastly, do we have to worry about depreciation and recapture? We covered that already, but again, because we're putting everything to use, that's not something to worry about here. So with that, these are the next steps. So submit your self-commitment here, a pretty simple bit.ly link, bit.ly/DW Select 5 or a QR code. Get your accreditation letter from your CPA, your attorney, or parallelmarkets.com. And it has to be a current accreditation letter, I believe, within the last 90 days or so. Work with your bank to make sure you can wire to LLCs and other bank accounts. Some of our investors had this problem in the past where they couldn't, and because they couldn't get their capital in time, unfortunately, someone else came in and took their spot. Fourth, once you submit your self-commitment at that link, keep an eye out on your email for the landing page, which contains the legal documents, the funding instructions, and more. Sign the legal documents, submit your funds. You'll get an invitation to the investment portal once we've closed the deal, correct, Courtney?
well, they'll normally get it on the first of the following month after they've invested. So let's say they invest on April 10th. By May 1st, May 2nd, they'll get an invite to the portal.
Got it. Okay. And then from there, once production starts, which again, we have no control over, but we can just provide estimates. It's everything that we love: tax benefits, a monthly cash flow, and monthly updates. So with that, here's our contact information. It's in the slides. We will send out the slides as well. Schedule a call, email us, whatever it is. We are, again, always available by phone or cell. We'd love to help you diversify into this great asset class, reduce your tax liability passively and legally, help you establish another great passive income stream, diversify. So reach out, ask as many questions as you want. We want you to feel comfortable and just follow the steps. We'll be sending this webinar replay out. We'll be sending out all of these materials, a data room, so you can get more comfortable with the materials, including this pitch deck. And we hope to have you join us on investing in North Dakota. I'm excited. I've invested in Wyoming, but never North Dakota, so it'll be a new add to the portfolio. All right.
Me too.
Yeah. Thanks, John. Thanks, Courtney. Thanks, Alex, for joining us. And we look forward to very successful investment.